Pfizer stock is currently trading very close to a 52-week low, down about 5% over the last year. And if we look at the past decade, it's actually trading very close to a decade low. And trading at this price actually gives Pfizer its highest starting dividend yield that we've seen in the past 10 years, currently sitting at about 6.64%. And if you just screen for this stock at first glance, it looks like there is a lot to like. Look at this. The price to earnings ratio is only sitting at 8.62. That's significantly lower than the average company in the S&P 500. If we look at the rating summary from Seeking Alpha Analysts, Wall Street, and the Quant, they're all giving buy ratings, but I'm afraid there's quite a bit more we need to dig into when it comes to Pfizer stock, especially since they just released their latest quarter's earnings and gave us a future outlook for 2025. So let's go ahead and dig into it. Now, if we look at the results of the recent earnings report, here's what we can see. Full year 2024 revenues of $63.6 billion, reflecting 7% year-over-year operational growth. So let's start to dig into that just a little bit more by jumping over to my profitability sheet. We'll come up here and plug in Pfizer. And all this data will load in. And like always, if you'd like to be able to download any of my spreadsheets and also get access to the ticker data add-on in Google Sheets that allows you to automatically import stock financials straight into your spreadsheet, then you can head over to tickerdata.com at the link in the description. Now, if we come over here and look at revenue versus cost of revenue. Now, to start off, we can see revenues are down significantly from the COVID era. 2021 and 2022 were record years for this company, where they saw about $81.2 billion in revenue, and in 2022, $100 billion in revenue. Now, keep in mind, that's more than double than what they were doing previously. So 2024 revenue did come in a little bit higher than it was pre-COVID, but definitely not at those COVID highs, with revenue currently at $63.6 billion. Now, one of the bright spots about this recent earnings report is look at the gross profit ratio. After 2020, it took a stark decline, as we can see, and in 2023, it got as low as 49.25%, but 2024, it jumped all the way back up to about 72%, which is much closer to being in line with their 10-year average gross profit ratio, so definitely one of the positives from the recent earnings report. But if we look at where earnings per share came in, 2024, about $1.42, which again we can see was higher than 2023 when it was just 38 cents, but quite a bit lower than it was in previous years. If we just look at the key results from the most recent earnings report, they did beat on top and bottom lines. So what's the reason for the huge sell-off? Why is it trading at a decade low? Well, there's a couple of different things that we can point to. If we look at 2025 guidance for Pfizer, here's what we can see. Revenues are expected to come in at 61 to 64 billion. So again, if we put that into perspective, there's not really any growth year over year. So revenues aren't expected to grow. If we keep scrolling down, we can see 2024 capital allocation. Here's one of the things we need to pay attention to. They returned capital directly to shareholders through $9.5 billion in cash dividends. So let's take a moment and see what that means for the stock. Now, if we zoom out, here's what we can see if we come down here. In 2023, the company paid out about $9.25 billion in dividends. So the company did increase the amount it pays out in dividends. And in 2023, free cash flow was only about $4.7 billion. So for the first time in 2023 in the past decade, free cash flow did not cover those dividend payments, leading to a high payout ratio. Now, historically speaking, this has been a stock that's been increasing its dividends over the past decade. It has a 5% dividend CAGR, and over the past 5 years, 3.25%. So we can see a history of increasing those dividend payments. But if the company paid out $9.5 billion in cash dividends, and we also see that net income for the company was only $8 billion, you can quickly see things aren't starting to add up. Dividends aren't free money. It has to be paid out from the company. So I think it's completely fair to start to question how sustainable is the dividend from Pfizer. Now, to be fair, this is something they talked about in their recent earnings report. They said one of the goals is to optimize capital allocation. So if we go all the way down to the 15th slide, let's dig into it. What we can see is one of the goals is to maintain and grow our dividend. Like we just saw, $9.5 billion was returned to shareholders. But here's what's really interesting. We have to remember there's 5 different things a company can do with their capital. 1, they can reinvest back into the business, which we can see is the main priority for the company. 2, they can also pay down debt, something else they've done. 3, attempt mergers and acquisitions, which we'll touch on later in the video. And then 4 and 5 are ways to directly reward shareholders. They can pay out dividends, and then they can buy back shares. But here's what we'll see that's really interesting. This company didn't buy back any shares in 2024. Now, share buybacks can be a great way to reward shareholders by giving you more ownership of the stock. But the huge issue with share buybacks at times is companies aren't able to do them when they need to do them the most. Share buybacks are most effective when you can buy back stock at a low price, and Pfizer obviously trading at a decade low, but they don't have the capital to currently buy back shares. It's kind of ironic. But what we can see is post-Seagen deleveraging, this was an acquisition they had about a year ago. They expect a more balanced capital allocation between reinvestment and returning value to shareholders. So when I look at these numbers, it's pretty clear they're in a pretty tight financial position. Obviously, when we talk about a company like Pfizer, it's absolutely critical they reinvest heavily back into the business because that's where all their future potential growth comes from. It's all about what's in their pipeline. Which, speaking of pipeline, brings me to another concern I have about the company. Pfizer is currently facing a peak period of patent expirations over the next 3 years, which management estimates will cost the company almost 30% of their trailing 12 months revenue, or the equivalent of about $18 billion. That's a significant portion of their revenues. So obviously it's critical for them to grow their pipeline, and they've approached this a few different ways. Most notably, around a year ago, they closed an acquisition with Seagen, and this is a cancer drug maker company. The acquisition had a total enterprise value of about $43 billion, and if we scroll down, we can see they expected in 2024 that it'd contribute about $3.1 billion to their top lines. So at first glance, this does look like an expensive acquisition for the company in my opinion. And to add on to the pipeline, this is something they talked about in the investors presentation. And to be fair, this company did see significant growth in its oncology sector, which really is to be expected with the acquisition. But I'm not quite sure that that's going to be enough to offset losing 30% of your revenues when these patents come due. So there's some clear trouble ahead when it comes to growing the top lines for Pfizer. But the trouble doesn't just stop there. Investors have serious concerns about the current administration and what regulations they'll put into place onto companies like Pfizer. One of the things recently posted on the Make America Healthy Again website is that they plan to have increased transparency and accountability for these pharmaceutical companies. Now, obviously, that's a pretty broad statement. We don't really know what all that will entail, but it's probably not good news for companies like Pfizer. So what all does this mean for Pfizer? Is its worst case scenario already priced into the stock? I mean, they are trading at a decade low, and we do all know the quote, "Be fearful when others are greedy, and greedy when others are fearful." So let's take a look at Pfizer from a valuation perspective to see what's going on. Now, what I want to do is jump over to my stock valuation spreadsheet and come up here and plug in PFE and hit enter. And all this data will automatically load in thanks to ticker data. Now, the first valuation that I want to pay attention to is going to be Graham's valuation. And this is a valuation model invented by Benjamin Graham, and it's based off the earnings the company generates and the future earnings potential. So we can see the formula right here and the model built out right here. Now, the first thing we need is the estimated earnings per share average for the next year. And with the ticker data function, we can easily bring this in. I'll just type in ticker data, come up here and select Pfizer, select estimated earnings per share average, and we want it for 2025, and I'll hit enter. And what we can see is estimated earnings per share is about $2.94. So let's just go with that number, what analysts are telling us, what the average expectation is. Now we need to apply our growth rate projection to the earnings of the company, and this is where things get pretty interesting in the case of Pfizer. Like we already saw, top lines really aren't expected to grow at a very high rate over the next few years. And in fact, if we jump over to Seeking Alpha, let's just look at earnings growth expectations from some more analysts. What we can see is earnings really aren't expected to grow at all over the next few years. If we look at 2025, they're expecting about negative 5% growth, maybe some growth in 2026. But if we look at where we end up in December of 2029, they're expecting about $2.70 when expectations in 2025 are $2.95. Earnings are actually expected to decrease. Now, this is a really important point to make because when we look at the forward-looking price to earnings for this company right now, sitting at 8.62, yes, it does look cheap at first glance, but typically when you buy a stock, you buy it with the expectation that they're going to grow their earnings over time, not the opposite like we're seeing with Pfizer. So in all reality, you could probably make the argument that a growth rate projection of 2 is a little bit on the high end for a stock like Pfizer, but after applying these other metrics, such as the current yield on AAA corporate bonds, we come to an intrinsic value of just $24 per share, which is pretty close to the current share price for the company. Now, the next valuation we're going to look at is going to be our dividend discount model. Again, we're valuing the stock based on how much it's paying out in dividends and how much that dividend is growing over time. And like we saw earlier, historically speaking, this company has been growing their dividend payments. But that's going to become more difficult in the coming years if their free cash flow isn't covering their dividend. So let's be generous again. Let's give them a dividend growth rate of about 2%. Assuming a discount rate of 8.5%, we come to a dividend discount model price per share of $26.52 when the current share price is sitting at about $25.60. So again, we get really close to the current share price for the company. If we jump over to our output tab and average the two valuations that we used together, we come to an intrinsic value of $25.26 per share, which is very close to the current share price. It's only off by about 1.5%. So with a 10% margin of safety, your acceptable buy price would come in at $22.74. So what's the takeaway? To me, this is a clear scenario where you have to dig into things a little bit more to have a full understanding with what's actually going on with the company. Yes, things like the fact it's the lowest it's been in a decade, it has buy ratings from analysts, and it has its highest starting dividend yield in a decade, all look attractive, especially when you look at the forward-looking price to earnings ratio, but it's clear it's cheap for a reason. Whenever you have negative headlines that you think might be pushing down the stock, you have to ask yourself, is it a short-term headwind or a long-term headwind? Because if it's a short-term headwind, it could potentially be a buying opportunity. But in the case of Pfizer, I think they do have long-term headwinds ahead. You could certainly make the argument that the Make America Healthy Again platform is a short-term headwind, but when I look at things like slowing revenue and losing patents in your product pipeline, I would argue those items are long-term problems. So for me personally, Pfizer is a stock I'm not interested in, and I'd even argue that the dividend payment could potentially be at risk moving forward. But go ahead and let me know what you think of this stock in the comments down below, and like always, if you'd like to be able to download any of my spreadsheets and also get access to the ticker data add-on in Google Sheets that allows you to automatically import stock financials straight into your spreadsheet, then you can head over to tickerdata.com at the link in the description. So with all that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.